Good morning or good afternoon, everybody, and welcome to another session from Lendit FinTech. We are delighted to be talking about what I think is a fascinating topic, and that is credit personalization. Because when you look at the broader economy here, you see personalization happening in so many different areas. I mean, it really got going with Netflix and Amazon, Spotify. All these internet companies are really creating personalized experiences for their customers, and they're doing it extremely well, and they've been very, very successful doing it. So what about finance? It hasn't really happened that much, particularly in the lending space. There's some fintechs that are trying to change that, and that's what we're going to be talking about today. Is really the journey to credit personalization, because I think it's inevitable. It is something that is gaining traction, and we will be, I think we will be living in a very different world in a few years, but it's going to be a journey, and we're going to talk about that journey today. And we are delighted to have with us two very accomplished executives. We've got the CEO of QUASH, Yoel Gavlovski, CEO and founder of QUASH, and Michel Caputi, CEO and General Director of BANTRAB. And before we get going, just a quick shout out to QUASH. They were able to They were a startup finalist in TechCrunch's, actually in Visa's Everywhere initiative, which was broadcast on TechCrunch, and which recognizes innovation in Latin America. So congratulations for that. So without any further ado, let's start with introductions. Yoel, why don't you introduce yourself real quick?
Thank you, Peter, and hi, everyone. Basically, in QUASH, we are allowing financial institutions to increase credit originations to their underserved but credit-worthy applicants using more than 1,000 alternative data sources, and auto machine learning capacities. And so in the last 12 months, we have processed 30 million loans in 10 countries and 14 financial products. So we are having massive amounts of repayment events being processed throughout our AI credit engine. And so we're seeing a lot of the market right now, and we're seeing how all of this work that we're doing takes in the long run to all of these financial institutions achieving credit personalization.
Okay, great, thanks. And Michel?
Hello, Peter. Hello, Yoel. Hello to everyone that is watching us in this webinar. It's a pleasure to meet you guys. I'm Michel Caputi. Since 2017, I'm the CEO of Grupo Financiero BANTRAB, that is focused on Guatemala operation. But on my previous job, I'm a former city banker from around 9 years in all Central America and in some countries of South America. It's very interesting for us, this conversation that we will have, because the future of the credit is very aligned. That the words that you say previously, Peter, that the conduction as Netflix, Amazon, they are creating these paths or these customer journeys very personalized. And us as a bank, we have to take that path, and we see on the near future and the actual today, QUASH and other firms like a very huge ally to comply this expectation from the market.
Mm-hmm, mm-hmm. Okay, so let's just kick it off and delve into credit personalization, because I know it's not obvious what this means. So Yoel, why don't you give the audience an explanation of what you take this to mean?
So in a very simple way, credit personalization is the opportunity that a financial institution has to not only be more relevant in terms of what their potential or existing borrowers might want, but to also have the best offerings in terms of interest rates and conditions, right? So relevancy is something that we are very used to in all industries, not only in the financial industry, as it's as simple as opening Instagram and seeing how 2,000 advertisers can actually be relevant to what you potentially might like. But that's one end of the credit personalization task. The other task is how to ensure that to have the best offering in terms of interest rates and conditions, and that's handled not from the marketing team but from the credit risk team. So each department have different KPIs, completely separated, and as a result, they are seeing low relevancy and basically offerings that might be better than their competition, but far away from what they could achieve. So what basically credit personalization enables, done in the right way, is the capacity to overlay both worlds, marketing and the credit risk, overlaying models that allow financial institutions to have a single risk profitability view on each borrower, to understand, to make decisions on time, right? When to cross-sell, when to upsell, when to enrich with alternative data, when to launch models, like so many things that we can do if both departments work seamlessly in a perfectly a zone.
Interesting. And so, Michel, I'd like to go to you. You've started this journey, but what attracted you, and what do you take credit personalization to mean?
Yeah, first of all, no doubt about it. About Yoel described as a team on the financial organization typically works in silos. That it's a reality that we are coming to change, and that it's a step that all financial organizations are taking to evolve and to adopt the agile methodology to work with multidisciplinary teams and to have more ability and more reduce the time to market. But as of today, in BANTRAB, as a financial institution, we have evolved during the last years to profiling the customer. But to do this, we have to invest a lot of money in teams, in infrastructure, in capacity, in education for employees, to creating this environment that we can understand the client. And starting from there, we are beginning of creating the products to the focus with reduce the friction that we have with the clients. This is the ultimate goal. We want the customers don't have to make a lot of efforts to have a product in BANTRAB. And that all investment and all the data that we have, it's very relevant and very important. But to us, with QUASH models, we have more data that we can access, that because they have it, and they have a more efficient algorithms that take decisions on that data, because they take decision not only in the data that as financial institution as BANTRAB, they take third parties data to take better decision than we can have, because they have a view that it's complemented with a very right data. But they are not only taking decisions for a single contract per se. They can take decisions to a population to describe their characteristic, to go to one, to be bad or to be good pay, or whatever we need on that. And that is very important, because the time to market here and the capacity to take decisions very fast and to don't let money in the table, basically, because if I don't take the client, the other bank will take it. It's very important that we can complement all the decisions that we make. And that is where QUASH, we see the add value to the decision that we take from our risk, from a risk evaluation view, because they have all this panoramic view about the market.
Right. Okay, that makes sense. And I love what you said there about you can't really start the personalization journey until you understand the customer, and that's really what it's all about here. And so, Yoel, I want to, I mean, Michel has touched on it there, but I'd love you to kind of paint a picture for what it's like. What a financial institution is like before they start on this personalization journey and what it's like afterwards?
Definitely. So before I can tell you like big bang, going a little bit outside of the BANTRAB use case, one of the biggest banks in Ecuador, for example, they last week before meeting us for first time, they were like had like 30 or 40 members staying up to 8 p.m. Everybody in a committee trying to come up with new segments of individuals with the analytics team, with the credit risk team, with the marketing team, everybody there. And as a result, they basically ended up getting like 2 million out of 7 million Ecuadorians downloading a TXT, pre-qualifying some individuals from the credit risk, then taking it to the marketing world. So, and the data that they came up in that TXT file, not only was a manual process that you saw, nobody in that room wanted to do it, right? And so it's not only manual, but it's based on historical data. And it works on a reactive way. So let's dive into that. So first, speaking about historical data, what do we mean with historical data? Historical data is when a financial institution, for example, measures that those 2 million individuals had a different delta in the credit risk score in the credit bureau between two particular periods, and they saw some changes that gave them the confidence to potentially give a loan to those individuals who they potentially rejected in the past, right? So the opportunity that we have here is to go in from manual based on historical data and in a reactive way to go automatic based on predictive data in a proactive way. So how can we achieve that? Basically, let's just to put you in context. Imagine if you are driving your car and you're seeing the back mirror of the car and you're trying to predict the streets that are coming based on the streets that you just recently passed. So it's exactly that. Like if you see the changes in the credit risk score, that's historical data. That's not predictive data. But now we have these, AI and machine learning algorithms that are basically taking millions of signals of all attributes, characteristics, and dimensions that individuals are living in the application process. We clash that with the historical loan performance of the financial institution. We clash that not only with the credit risk score, but with all the different attributes that the report of the credit bureau brings. We then clash that with the aggregated power that we have processed in our AI credit engine that in the next 12 months will be 100 million repayment events. And then we also use the most cutting edge advanced credit algorithms that we're seeing globally. So as a result, what happens mainly is that big financial institutions can have data scientists, right? They do have algorithms, they do have a lot, but they have hundreds or thousands of algorithms that doesn't have a commercial application in the market, and they don't fit with their credit risk. So by us having this aggregated vision, we are using synthetic data that it's allowing to get 10, 15 more points in the Gini, in the KS, Lawrence Box, all of these different technical metrics that are helping them take commercially much faster all of these algorithms in order to increase origination with no additional risk and many other KPIs.
Interesting. That's really interesting. So Michel, let's just take one piece of what Yoel said. I wanted to talk about the AI machine learning aspect of this, and how are you guys? Maybe you could explain how you guys are using machine learning on this credit personalization journey.
Yeah, thank you, Peter, for the question. One of the things of this AI we have inside of our organization, we have several information and we take decision with this. And one of the layers that we are creating with QUASH is breaking the bias that we can have building our own models or buying models that is created for the market. Because with QUASH, we think and we hope that like this model is very enriched with a lot of data. It's breaking the bias that we can have because the person doesn't have a formal job, or don't have a house or a car or a credit historic review. And all these paradigms are getting broken by QUASH, because they are looking in another way to another data, constructing all this information and this decision based on the comprehensive and comportamental described about the client or about the person. And this is a pillar here in Central America. It's a central idea, because we have a very huge opportunity to bankerize people basically in Guatemala. We have only like 35 or 40% of the person, they are formal related to a bank. But that is including an issue, because they are related to a bank because they have a bank account. But if you have a bank account, you are not bankerized, because you don't have access to credit. And the credit is the booster of the economy and the person living. And only 50% of the Guatemalan people have access to a formal credit. The rest of them, they go like, I don't know, to informals that it's get a very bad rates. The informal economy, it's not positive, because you increment the risk of money laundering, anti-terrorism, etc. And that is why this software and this work that these guys in QUASH made, they can give it to us new segments or new nodules of potential clients that we can onboard into them with a very secure offers of credit. Because if the person doesn't touch the financial institution by any way in the story of his life, suppose that he has 20 years right now, I don't have information to take a decision. I may assume that his profiling is maybe similar to one that I have inside, but with the data aggregation that we are finding with QUASH, is because they have a commercial institution, they have other type of industry that they are receiving this person, and he's buying, he's transactioning, he's doing a lot of stuff. And this data, it's the main value that we see on this potential of artificial intelligence. I think we are 2 steps behind that we want to get, because the alliance between QUASH and the formal banking will get through the result that we will have systems that can make automatic decisions to get that offer. But I think we are 2 steps behind of that. We have to build some capabilities right now on this, but we are on the right path. I think so.
Yeah, and that's what I think is most exciting about how fintech is developing in Central America, throughout Latin America, actually, and that because what you just said there, 50% of the people don't have access to credit, and it's really a data problem. That's all it is. It's a data problem, and by getting the right data, you can suddenly provide credit to many millions, tens of millions, hundreds of millions of people throughout the region. So I want to dig into data. Before I do, just a reminder to the audience, if you want to ask a question, hit the Q&A button and type it in. We will get to questions here towards the end, but I would love to hear your thoughts, what you want to ask Yoel and Michel. But Yoel, I want to expand on this data piece, because it's really critical. I mean, that's how we are going to be able to expand access to credit. So can you talk about the different alternative data sources that QUASH is using here to really bring about this credit personalization?
Awesome. Just before jumping and into all the different alternative data sources that we have, I want to basically first, obviously, if all directors and presidents in banks in Latin America will be so forward thinking as last idea that Michel explained, obviously, it will simplify much more the work that we're doing today. Right? So super forward thinking, they are kind of thinking 2-3 steps ahead, and that's what actually makes them super competitive. So just before jumping into the specifics of what alternative data sources we use, I wanna keep adding to that vibe that Michel brought with other different things that we're seeing in the market, right? For example, in Mexico, one of the top banks partnered with one of these delivery companies, and we're seeing that because of that alliance, they are separating between good and bad borrowers 16% more efficient, right? So how can the other top 4 banks in Mexico will compete in the next 5 or 10 years if they are not having this behavioral data about delivery, right? If somebody in Panama, for example, which we have the data today of 2 out of the 4 million Panamanians that have used delivery apps in all the pandemic and COVID times, we easily can see that somebody that bought once every month for 12 straight months, $100 in delivery, they would definitely pay a $500, $1,000 loan without even seeing that individual in the credit bureau. So those are the type of changes that we're seeing. In the case of BANTRAB, for example, we're making alliances with retailers there so that they can get all of this behavioral data that Michel was mentioning. For example, making groups where big retailers and banks partner together to basically kind of match those individuals that apply to a loan and that also bought, for example, a TV or a washing machine. What's the difference in those type of behaviors that will help them predict better and separate better between good and bad borrowers, right? So jumping straight to your question, if somebody's prepaid in top-up minutes in the telco, potentially he's not in the credit bureau. So if he's not in the credit bureau, how many times he have recharged his phone in that 90 days? If he did that 3 times, doesn't have only the ability, but the willingness to pay a loan once every 30 days. We have 100% of the IPs and VPNs in Latin America, where we know if somebody belongs to a top 5% with most stable internet connection. We can add a pixel to capture the taxonomy of the web or app, or all the digital data footprint of that individual when he applied to a loan, and sees things like 250 behaviors that allow us to predict repayment events. Like, for example, if he used autocomplete, we use LinkedIn to know type of employment, type of role, when was the last time he changed job. We connect to 12 open banking data providers in a waterfall model, so our client makes sure that he pays the least amount in terms of data. And for motorcycle loans in Honduras, we use psychometrics and so on, right? So those are 5 or 6 out of the 1,000 alternative data sources that we have.
Yeah, super interesting. I mean, I could delve into each one of those, but we don't really have time, I'm afraid. But I want to maybe there's this question just came in from Andrea in Colombia, talking about the same problem that Michel just mentioned. And I don't know if there's anything specific you can talk about to Colombia, but the question is, is the information that QUASH would give, financial institutions to make a decision, what is the difference between the information you can provide than what they have access to now? I mean, is it really what you're just talking about here, the alternative data sources?
So she was mentioning go ahead, Michel, sir.
No, please, Yoel, go ahead and I follow you.
Yeah, no, basically the question, if I understood well, was the difference between what they have as a financial institution versus what we're bringing.
Yeah, I think that's fair. Yeah.
Awesome. Yeah. So at the moment we meet with a financial institution, and Andrea just validated that. Is that once we meet a financial institution and we sign NDA and we go into all the compliance and regulations that we can speak later on in terms of privacy and things like that. 10 days after we meet a financial institution, we already know they already provide some sort of anonymized information that helps us understand the reality that they have internally in terms of the markets and the financial products that they have and the needs that they have. So they can actually, in 10 days before making any commitment, kind of see what added value in terms of our aggregated power, using our nonlinear models in high dimensional spaces and cutting edge AI credit algorithms, how does that AI layer on top of their data would actually help them get more efficiency in how they separate between good and bad borrowers. On top of that, we bring external data. So it's a mix of both. It's a hybrid approach. And at the end of the day, it's not only about what AI algorithms we bring with our aggregated power or our alternative data catalog, but the technology that we use to help them prove the value that these alternative or predictive data sources generate to them, right? So with a minimum cost and maximum profitability, we enable them to see the right sequence of alternative data or predictive data enrichments that they should do. Because if they test for something first that they should have tested in the 8th position, they inhibit their capacity to iterate. So we're seeing many cases of financial institutions testing alternative data for first time, and then for 2 years, they don't test anything else because they inhibit it. They went to the committee to get a second approval, and they didn't get that one. So that basically prevents them to become more competitive for 2 years. And and we're in the data era, right? So that's about it.
Yeah, yeah. And so maybe Michel, we can get into sort of a real example here about, what at BANTRAB, what you're actually using when it comes to alternative data, what you expect, how you expect to be leveraging QUASH, and what the data sources you'll be using.
Well, we are making our first step. Also with QUASH, we are making our first step, and in order of that idea, also I want to talk about this topic, Peter, because it's very important, because we have people of different countries. On the regulation side, there is a room of improvement, because in some countries, as I'm going to speak about Guatemala, we don't have regulation about the privacy information or the data privacy. We don't have regulation, but that you can see it is like an opportunity or is a very high risk, because we have to take decisions with a very great area on this thing, and we have to take decision, and we have to take some risks for this aggregation of data and to understand the data from our clients. And that is a very important from our sides, our banking sides as a banking association, and all the layers that we have in our country, that we can push through that to close that gap that we have on regulations. First for all, to protect our clients, because the clients is first of all. On the second time, also to protect our services and to protect us as an institution, to use that information in matter to contribute, to make a contribution to the life of this person or companies or SMEs or whatever. But in that order, we are very cautiously on this, because we are making our first step to get that joint venture between the commercial house that Yoel talked about in Guatemala, that it's a very big one, and BANTRAB. We are seeing a document that is very extensive but very comprehensive to understand how we can manage through this third party, because this is very important. QUASH is going to be the third party on between, and that it make guarantees to the client that I'm not seeing the information that he have on the other company, and the client can be unconfident that the bank is not sharing also the information to this third party in commercial. And that is very important to this, because it's like a burning, it's born like a governance of this data. And the data governance in the institution that we manage it's very important. Also, we have to improve this data governance, not also in the regulation level, also in the inside about our organization.
Right.
But yeah, the first step that we are doing with QUASH are these on the type of the data aggregation, and right now we are in the data validation day. We are doing our step, but in the first hand that we have with the information that we can manage to have only as BANTRAB without QUASH, we are having a very good results. We are incrementing our position in a full credit from a client, just understanding the behavior through their buying through the debit cards or to credit cards. That it's the very limited view that we have. And that is the issues that we have with QUASH, because they have a very huge view from the market. And if we have the results with only our data, we are planning to have a booster that's very high with QUASH.
Right. No, that makes sense. And so I actually want to talk about that, the results here that you just talked about, Michel. Maybe Yoel, there's a question that's come in from the audience here. What is the delta in outcomes between algorithms versus human decision on a case, and obviously that's a credit decision. How far or close is it to the right decision?
Yeah. So the short answer on that is, in average, in ballpark, after having between 80 credit risk directors that are running today, like 100 to 150 A/B testing advertising campaigns that are running with us, we're seeing increase in between 30 to 40% originations, credit originations with no additional risk. That's kind of the ballpark, the short-term answer. But we're seeing different cases. I mean, depending on the region and the financial product, the outcome is differently. Technically wise, I think he's mentioning to Gini, KS, Lawrence, Voxel, vintage analysis, performance inference, all of those metrics that allow you to get more efficiency in how you separate between good and bad borrowers. So you're seeing financial institutions that are not using AI and are only basing their decisions in Honduras, in Central America, and in all of these countries. And they go out and use the credit score of Equifax or TransUnion and so on, and 70% of the individuals are rejected. So with us, that's where only the AI and the predictive capacity increase 30% the capacity to separate between good and bad borrowers, and as a result, provide that lift in originations with no additional risk. But then you have more sophisticated cases, right? You have clients that have amazing data science and AI teams in-house, and they're basically looking to leverage from our aggregated powers to increase 5, 10, 15 points in the Ginies or in the KS only with the predictive data. And if they don't see a big lift, that's when they start adding all these alternative data sources that in a 1,000 data sources catalog.
Right. Well, maybe you can just expand on that a little bit. I'd love to talk about the different use cases. What are the best use cases for this for credit personalization? Maybe you can, for the Latin American region. What can you comment on that?
Yeah, and I think that this connects a little bit to what Michel was saying initially, that when he was mentioning about going 2 steps back, right? So if we have as the ultimate goal credit personalization, what we're seeing and the use cases that we're seeing is that for you to personalize an offering, right, you need to or if we go forward to and connect with the one-to-one marketing dream, where basically you have a specific product design or a financial product specifically designed for a particular person, that's ultimately the goal of everybody, right? If you can actually build dynamically in real time a financial product based on the behaviors of that individual, that's going to be the winner. And companies like Alipay, WeChat, PayPal, RappiPay, RappiBank, and Mercado Pago are positioning into getting there faster and before everybody, right?
Right.
So all of the rest financial institutions need to get there if they want to compete and achieve credit personalization. So in order to go 2 steps back to what Michel was explaining before, is that for AI to work, you need massive amounts of data, massive amounts of information. As you, so specific use cases go from little financial institutions that want to pass from using just historical data to predictive data to very sophisticated fintechs and banks in the region that although they have all the money, all the data science team and everybody, they not only need a provider that wants them to basically identify and to negotiate with these 1,000 data providers, which next year will be like 3,000, somebody that reduces those hassles to negotiate with 15 data providers in telco, 15 in open banking, 15 metadata, somebody that actually can bring them the best of the best and specifically what they need in a Silicon Valley approach, very low cost and results and seeing results fast. So as we move from those 2 steps back, where you start adding AI and you start adding alternative data, you then start moving to that credit personalization one-to-one dream. And for you to achieve that, we are familiarized with the clustering technique, with which we call campaigns, right? Or creditvertising campaigns, which is nothing related to advertising or to lead generation. It's just the capacity to A/B testing, to transition from that champion challenger, slow and inefficient technique that wasn't designed to test the value that these new data sources bring, to the A/B testing applied to the credit world. So as you move granularly to clusters that have less people but higher confiances, you will be will be moving much closer to that credit personalization idea.
Yeah, no, I think, I mean, and say marketing have been using A/B testing for a long time, and it is, it's become a real, just a standard component of marketing campaigns, but we haven't seen it as much in the credit space. So I like that, what you're doing there. But so Michel, I want to turn to you for a second, because you're the CEO of a bank. You've got a lot of different things that are on your plate. I'm sure you've got a lot of competing priorities. What sort of is what is the level of priority for credit personalization inside your bank today?
Well, today is part of our main strategy for the next 4 years to build up a highway to credit personalization, because QUASH is one of the dots in the equation. QUASH, and I have to be sincere in this, is not all of it, because if QUASH told me who wants or these persons, what type of credit of behavior have, but if I don't have the right channels to get on board of this client, well, it will fail anyway. And that is why we have to have a very clear strategy to make the construction of this highway to the credit hyper personalization, or as we call inside the organization, design human components. Because as an example, on BANTRAB, we have an anthropology unit that is studying the comportamiento about the person, because not everybody wants to deal with an application. Someone wants to go to to an office or to talk with someone, or they want to make a phone call. And we are understanding all these type of customer behavior to understand where is our capability and how we can boost our capability to put a product on this person. But as I say before, QUASH is one of the dots, but on these dots, it's very important because it's measured the risk that we are willing to go to the market. It's very important. It's very important to us, to the board, to the owners, because it's how, bottom line, it will affect the loss loan reserve and all these credit criteria. It's very important in the bottom line. But in the hands of the strategy, it's also very important that all the organization is aligned and focused and where we're gonna pursue as a client, and how we're gonna onboard these clients. For us, we are a bank that is very focused on retail banking, or 90% of our clients it's from retail, our individual person that it's Guatemalan workers with an income that is below $1,000. And that is our main focus, to make this build of capabilities to attend and to amplify the quantity of person that we are seeing. Right now, we are making an evolution, because before the pandemic and after the pandemic, the entrepreneur are beginning to get traction here in Central America and also in Guatemala, that it's a self-employee basically, but in other level, not maybe the lawyer or the doctor self-employee, it's other level of self-employee. And we think using as a partnership with QUASH, we're gonna get more understanding about this self-employee that is different than a professional self-employee. It's more that conductual one, and we know that he's purchasing something in some commercial establishment, he is making some investment or whatever, that it's not formally bancarized. But we think with QUASH, we can have more insight about this profiling and about the risk behavior, and we can take best decision and how much money we can risk on this segment, and how far we can go with them.
Right. So
with more certainty also.
Yeah, right, for sure. So then what are the products? I mean, is this for personal loans, for credit cards, for home loans? What are the products you're wanting to use this for?
Well, I think we in banking, we can use it for whatever product that we want. Our product, like, I don't know, credit card, that you can see how much of the market you are penetrated, and you can put a goal to penetrate more using QUASH on that leverage, or you can open a new nodal of customer that it's unexplored by the system. As I say before, in Guatemala, it's a green field on that, because no, the minority of the persons are the ones that it have the opportunity to have relationship with a bank. And for us, that green field, it's like blur in data, because they are not related to us. And that is, we have to get a partnership with someone like QUASH to get more clarification on that type of risk that we are focusing on. But in matter of fact, punctually, you can use it on credit personal loans, mortgages, credit cards, SMEs. I think it have a lot of potential. Maybe if we talk about corporate credit, it's not the tool that you will need.
Right. Yeah. Understood. Okay. So moving on, before I move on, just a reminder to the audience: if you have a question, type it into the Q&A button, or hit the Q&A button there and type it in. We'll get to it before the close of the session. So, Yoel, going back to you, I want to talk about sort of what's different between QUASH and other players, and I'd also love to get your perspective on like Upstart is a company in the US that's doing really well. They went public like 6 or 8 months ago and have done extremely well. They brought a lot of awareness to to sort of bringing artificial intelligence to lending, but obviously they don't operate in Latin America. But would love to kind of get your perspective on how QUASH is different to the other services that are out there.
Awesome. I'm going to start with the last question, right? So for those who are not familiar with Upstart, which is not a company and not related with us, there has been a lot of comparison between Upstart and QUASH as two separate different companies lately. About a year ago, they compare us because we are both AI credit engine companies, right? So one, Upstart serves US, QUASH serves Latin America. Basically, the hype of AI credit engines occurred around not more than a year ago, when Upstart decided to go public, right? So we transitioned from seeing AI credit engines as theory articles of McKinsey to actually a real company that made IPO, which is Upstart, right? So the main difference that we have with them is that in US, credit is completely different to Latin America. In US, you have a lot of leads coming from Credit Karma. Upstart filters out them in their AI credit engine, and then they resell high qualified leads to their bank partners. In Latin America, the lead is inside the financial institution. So in the last 6 months, I think BANTRAB have, I don't know, rejected or have processed around hundreds of thousands of individuals. In Latin America, we have 500 out of 600 million Latin Americans that lack access to affordable credit. So those individuals are not in Credit Karma, are in the financial institution already. And so we only need in QUASH to empower that credit risk director so that he basically can use AI, predictive data, alternative data, and our A/B testing campaign technology to actually start approving them. So we're basically, it's like kind of a transition where personally we searched in the past in Encarta, and now we're searching in Wikipedia, and we didn't went back there. Now, credit risk directors in the data era, we know that models are as good as your data is. So currently, as Michel said, the credit risk directors are siloed with their own data and models, and that's not competitive anymore because of the use case that I explained to you in Mexico, how the second largest bank in Mexico, it's basically eating the market with this alliance that they did with a delivery company. So, in terms of that, is about empowering the credit risk director by giving them a window where they can leverage aggregated learnings externally from them. So companies like Upstart or QUASH, we don't lend. We just process massive amounts of repayment events, and including all of these alternative data sources. Your second question, how do we differentiate with competitors, right? So let's say, for example, we have in one end data providers that are trying to do scores, that are trying to get into the credit risk, but it's a whole different world, and we haven't seen them advance as humbly we are today in just focused into that. So we let open banking data providers to generate KPIs, and we let these metadata providers and telco and segment, all of them are changing. And we're in the data era. It's like if we are in the crude industry and the oil industry 100 years ago or 200 years ago, but now this is the data era, and that's a changing environment. But the one thing that it's constant is your capacity to test first something that will be really, truly profitable for you. So that's data providers, we have them on one end. Also, we have, for example, the most advanced credit bureaus that are like, Experian, Parker, FICO Analytics Workbench. They do allow these financial institutions to connect AI algorithms with Python, R, H2O to the credit risk decision trees, but they're not using, they're not an AI credit engine. And the main difference with them and us is that, going back to the privacy question and connecting it with the competitor's question, is that in GDPR and CCPA, which are the two laws that regulate all the privacy environment, data collectors are the ones who process identified information. That's credit bureaus, that's financial institutions, that's data providers. In QUASH, we are data processors. We can't access to identified information. We don't know names, we don't know phones, IDs, addresses, nothing. So using virtual servers and different technologies, we're able to cross all of this information without having the identified keys. The identified keys are being transferred between data providers, credit bureaus, and financial institutions throughout technologies that we use. So in that case, credit bureaus can't have that aggregated power where we are processing hundreds and thousands of algorithms that we're just every month writing to all of our customers out of machine learning recommendations every 30 days, of which algorithms went up from 60% to 70% confidence that now are ready to use commercially wise, adapted to the risk appetite.
Right. Got it. Okay. And so I do want to touch on privacy with Michel, but before we do that, question came in here. Does QUASH have plans to operate in Europe? Or you just
we have a country manager in Spain and Portugal right now. Currently, we just finished getting a huge market share in all Central America, Ecuador, Colombia. Now we are being focused like for 12 months in Mexico and Brazil. And then the plans for next year is to go to the whole European continent. Now we have a few different country managers in Portugal and Spain, but we're looking forward for next year to expanding that with a much faster pace.
Right. So Michel, I want to turn to you for a second, and you did touch on this earlier about the regulation and data privacy, because it is such an important piece here, because you can't use data. If data is not allowed to be used, then you can't use it. So how are you? What are the issues that you are finding around privacy?
Well, here in Guatemala, particularly, we can share the info from a client. We have to have their permission for that, but we relay that permission in the first step that we are engaging in contact with a potential client or with a client. And also, we have a strong governance inside the organization to protect the information from our clients. And if we are merging this information with data aggregation, as Yoel says, we don't share like phone numbers or sensitive information. We only share the information that can be an outcome for decision making in the evaluation process. We don't use for the process to to give credit or something like this, the zones or the place where the person lives, because we think this is discriminating, and we don't use that type of information anymore right now on BANTRAB. We are only using the information of the behavior of the person, and we are on top of that using the info that Yoel is creating around this. But on the regulation side, definitely it's a room for improvement, because like I said before, right now it's an empty space that maybe if we are like very responsible, we can take very well care from our clients. But we don't know that about all the market, and definitely the regulators have to step up on this and take maybe some benchmark in other countries that are regulating the data privacy, as in Europe or other countries. It's a very strong regulation around it, and the disclaimer that you have to do, and the moment that the person it's getting involved in your website and how the permission are and all of this. But I think on Latin America we have a huge opportunity there, because we have to set a very clear rule set to everybody know well the size of the pitch and what can I do and what we can do. Because if we begin to do this and then the regulation began to cut, there is the phrase that they use in Latin America. We don't have judicial certainty, because the rules change every time. But that is the opportunity that I see on that. But I think the responsible companies will treat responsible with very responsibility and accountability the data information from our clients, and that is one of our best offers that we're going to do this.
Right. Well, we're getting close to the end of the hour, but there's one more question that came in, Yoel, that I'd like you to at least share with the audience about. Someone asked, do you provide plug and play underwriting models? I presume that's someone who's sort of just getting started.
Yeah. So for someone who is getting started, what we typically ask is, there are two different small financial institutions or financial institutions that are trying to get into a new segment or a new financial product that they didn't have before. So basically the analysis that we do there is, first, do you have other similar financial product that you do have enough information for us to leverage and create something that it's not specifically from scratch, right? So we obviously try to do that, because the first ideal approach that we want to get is to use AI capabilities, and you need a lot of data, at least 10,000 variables and so on. But obviously, for those financial institutions that have data but have a little data and a product that it's not exactly the same, that do help. But we in that instance, we start using synthetic data from similar financial products in that specific market, and we start making assumptions where we allow them to actually go fast to production, right? So go out to the market.
Right. Okay. So as we as we sort of closing down here, I'd love to kind of look forward, and because from my perspective, it feels like this is just going to be commonplace. That every single lender eventually will have this kind of approach, and there will be a personalized type system in place. But we're not there yet. We're a long way from getting there. But how, like, maybe Michel, I'll start with you, and then Yoel, you can have the final word here. But what do you think the future holds here? Do you think that do you agree with me? Are all banks going to be using this in the near term future?
Yeah, definitely, Peter. I think you're right. This is like when we talk about, I don't know, 30 years ago, from the scoring of the scoring models that they have, all the companies and all the banks, and they're implementing this. And it was a huge game changer, because before the scoring proposition, you rely the decision to give a loan or not in the manager of the branch, basically, in the knowledge that he have and the expertise knowledge that he have about the client. But that model evolved in the scoring, and right now is the moment to evolve another time this model, and the evolution of this model, it have to be very, very, very related to the hyper personalization of the offer. Because if you ask to me, we will be the role of the banks in the next 10 years. For me, the banks will be this personalized about brand, and will be only a dot in the process for the person to get the desired product that they want. Mm-hmm. I'm gonna explain it with an example. You want something in Amazon and you love it, you're gonna buy it, and in Amazon, he doesn't ask you about which company of mailing you would use to send this to you. He only asks to you how much time you're gonna wait for this product. Right. And the algorithm, depending on where you are, how much time do you need, what is it, all the information that have the algorithm, they decide which company is the one that it comply your desire to receive this in 24 hours or 1 day. The same, it will be resolved with the credit for the person. The only asking that you will get if you want to pay today, or you want to pay it in, I don't know, 5 months, 6 months, or hello, Peter, you can pay this in 10 months, and that's it. The algorithm, it will take and will have the decision which bank is the better fit for you, for your profile, your behavior, and all of that. Which bank will add you more value to your profile? Because if we talk about our bank, that it's people that their income is around $1,000 per year. Do you think if I have a platinum or black credit card, it will add value to them? Definitely not, because there are featurings or perks that is not related with them. And that is the intelligence and the artificial intelligence that you are saying before, that it will take those decisions for us, and will we get to the path that we can have more benefits from the banks and from the relationship that we have with the financial institutions.
Mm-hmm, mm-hmm. Yeah, very interesting, Michel. So your last word, what do you think the future holds?
So I'll split the answer in two. One, it's on the social impact, and one is on the changing paradigm of the technology per se. So on the social impact, we're seeing, that Denmark, for example, that, for every $1 that you have, you can have $3 in debt. In comparison to Latin America, where you have 500 out of the 600 million Latin Americans that lack access to affordable credit at all, and the 100 million that do have are not having the best offerings in terms of interest rates and conditions, and they have like 0.2 based on $1 that they have in income. So we're seeing a huge expansion with all of the different data sources that we're seeing now in terms of financial inclusion. So it's that individual that couldn't pay for medicines or student loans or buy cars, or like I have a lot of friends that are earning a lot of money in Panama and all of these different countries that they don't have credit profile and they can't have a mortgage. And that's, that's very, very, they just immigrated 2 or 3 years ago to Panama, but there are people that, their families have had a lot of businesses for many years. So it's a very, very important issue in terms of the social impact and financial inclusion. In terms of technology, we are seeing that once technologies like QUASH get a lot of money and make this type of proof for dummies technology where it's much more self-service, you're going to start seeing QUASH credit advertising campaign technology which has nothing related to advertising or marketing, but the advertising capacity to actually run these hundreds and thousands of A/B testings will get much simpler, less manual, right? More self-service. And at the end of the day, you're going to see small financial institutions without anybody helping them running these A/B testing campaigns that will allow them to leverage alternative and predictive data in an automatic way.
Right. That's we'll have to leave it there. That's you know, I think the future is coming fast, and what the picture you painted there, Yoel, is something that I think is going to be incredibly exciting to watch. Here at Lendit FinTech, we will be paying attention. In fact, you know, before we sign off, you know, we're going to be revisiting this conversation again and again. I suspect over the coming months and years. And you know, we have, just a quick plug, if I may, we have our Latin American event coming up in December in Miami. It'll be a hybrid event, in person and virtual, and I'm sure this will be a topic that will be discussed there at length. So with that, thank you, Yoel. Thank you, Michel. Thank you, the audience. Appreciate you listening, and we'll see you again soon.
Thank you so much, Peter. Thank you, Michael.
Thank you very much.
Okay.
Thank you, Joel. Bye.
Bye.
Thank you very much.
Bye.